All right, let's be honest. If you've opened your portfolio lately and just stared in pure frustration at heavyweights like Reliance, HUL, ITC, or IRFC, thinking, come on, why aren't these stocks moving? Trust me, you are absolutely not alone. It's incredibly frustrating, right? You feel like you own the absolute biggest, best names in the market, yet your portfolio is just flatlining. Well, today, in this explainer, we're going to pop the hood on these massive companies. We'll break down exactly what's happening behind the scenes, and more importantly, how you can strategically navigate the stagnation without losing your mind. So when you look at a stagnant screen, it is so tempting to just rage quit and hit that sell button. We're talking about absolute market giants here. Reliance, IRETA, HUL, ITC, IRFC. But ask yourself, is blind panic selling really the answer? Absolutely not. Because the single biggest mistake you can make in the market isn't getting spooked by a falling stock. It's dumping a company without actually understanding why it's falling, or, just acting entirely on emotion. Okay, let's dive into a foundational concept here, because this is absolutely crucial. A fantastic company and a fantastic stock are not always the same thing. Think of it like buying a massive luxury mansion. It's a gorgeous house, sure, but if you overpay by a few $1,000,000, well, it's a terrible investment. The same goes for the market. You can have a brilliant, fundamentally rock-solid business, but if its valuation is way too stretched, its earnings growth is slowing down, or its broader sector is taking a beating, that stock can and will move sideways for a long, long time. Just because a stock has dropped 20 or 30% and hit a 52-week low doesn't automatically mean it's a screaming bargain. All right, let's move into Section 1, Status of Giant Stocks. First up, the Titan itself, Reliance Industries. It recently closed around 1312 rupees, which is down roughly 18% from its 52-week high. Now pause for a second. Did Reliance suddenly become a terrible, broken company overnight? Of course not. Its business is massive, it's highly diversified, and judging it purely by a price correction is a huge mistake. If you're already holding it, try to avoid the panic selling trap. And if you're actually looking to buy, well, consider a staggered buying approach over time. Don't just throw all your money in at once. Now, what about major FMCG players like Hindustan Unilever and Dabur? They've faced some tremendous pressure lately. But before you make a move, you need a specific roadmap. You've got to run through this checklist. Are you actually seeing volume growth? Is there a genuine margin recovery happening? What's the real status of rural demand? And is overall earnings growth trending upward? Look, if the underlying business fundamentals are still strong, a long-term investor really just needs patience. You have to let these broader commodity cycles play out. Which naturally brings us to ITC. It's recently formed a whole string of 52-week lows. But the question you should be asking isn't, oh man, should I sell just because it fell? The real question is your original investment thesis still totally intact? Because if you bought ITC for its defensive exposure and that really strong dividend yield, your game plan is entirely different than someone who just jumped in hoping for a quick short-term flip. Don't let short-term price turbulence derail a solid long-term defensive strategy. And we are seeing a very, very similar dynamic play out in the IT sector right now with companies like Wipro. You simply cannot buy a stock just because the price tag looks a bit cheaper today. You have to verify that actual business growth is coming back. We're talking revenue growth, major deal wins, stabilized margins, real AI demand, and solid future guidance. A stock re-rating, which is when the market finally agrees the company is fundamentally worth more and starts bidding the price up, takes time. Never buy on price alone without double-checking those fundamentals first. Moving right along to Section 2, Railways and PSU Banks. Okay, this is literally the question on everyone's mind right now. Is the railway story just totally over? So many people bought into names like IRFC, IRCTC, and RVNL right at their absolute peak during that massive, crazy rally. And now, with prices pulling back hard, there's widespread panic that the whole growth theme is dead in the water. But honestly, that fear is likely totally misplaced. And here is exactly why. 2.93 trillion rupees. That is the massive railway capex, or capital expenditure, allocation for the 2026 to 2027 financial year alone. To put that into perspective, the government is still pouring an absolute mountain of money into expanding the network. The underlying long-term story remains completely intact. But here's the catch. There is almost always a timing lag between real-world business growth and the stock price returns. You just can't expect the stock to double every single month just because the macro theme is strong. Let's pivot to PSU banks like Bank of Baroda and Indian Overseas Bank, as well as financing names like IRETA. There is a really, really dangerous assumption floating around out there that just because a stock is government-backed, it's inherently a safe bet. Guys, that is not investment analysis. To actually succeed here, you have to actively verify their asset quality, check the credit growth, and look at net interest margins, NIM, which is basically just the gap between what a bank earns in interest and what it pays out. You also need to look at overall profitability. And crucially, especially for these volatile names, you have to wait for actual technical trend confirmation before jumping in. And this same fundamental logic applies perfectly to oil marketing companies too, like IOC. It's this constant, brutal tug of war between a juicy dividend yield and the broader business cycle. IOC is so often bought solely because its dividend payout looks incredibly attractive, but you've got to weigh that against the harsh reality of crude prices and refining margins. If that oil cycle turns sour, the stock price can be suppressed for a very, very long time, no matter how great that dividend yield might look on paper. Okay, Section 3, the biggest rule of averaging. Now we arrive at a critical concept: blind averaging. This is the incredibly dangerous psychological trap where we assume a stock is automatically cheap just because its price fell from $300 down to $200, or, $200, $250. Buying a falling stock solely based on the fact that it used to be priced higher is a fundamentally flawed strategy. Because honestly, even at $150, that stock could still be vastly overvalued when you look at its current real-world earnings. To avoid falling into that trap, you absolutely must follow a strict, logical sequence before you throw good money after bad. Think of it as a golden staircase. First step, analyze the core business. Second, verify the earnings are actually stable. Third, assess if the valuation even makes sense right now. Fourth, confirm the trend has genuinely stabilized. And only after you've cleared those 4 hurdles do you reach step 5, buy. Which brings us to our final part, Section 4, the right portfolio strategy. So, here's what I want you to do. I want you to ruthlessly categorize every single stagnant stock currently sitting in your portfolio into one of these 3 buckets. First up, hold. If the fundamentals are strong and your original thesis is completely intact, just exercise some patience. Second bucket, wait. If the business is okay, but the technical trend is incredibly weak, pause your buying to sit on your hands and await confirmation. And finally, the third bucket, review. If a company has deteriorating earnings, mounting debt, or your original thesis is just completely broken, you must actively review it and strictly avoid averaging down, period. And as you go about implementing this framework, keep this vital warning in mind. Avoid heavy sector concentration. Look, if your entire portfolio is stuffed into just banking, FMCG, energy, and railways, you are taking on massive, totally unnecessary risk. Oh, and please, the equity markets are absolutely no place for your emergency funds. Keep your safety nets safe, okay? I want to wrap up this explainer and leave you with one incredibly powerful thought. Share price can definitely test your patience, but an investor should never, ever abandon their analysis. The market ultimately rewards those who actually do the math, not those who just close their eyes and cross their fingers. So I would love to hear from you. Which specific stock in your portfolio is really testing your patience right now? And after going through this, are you going to hold, wait, or review? Let me know down in the comments. Thank you so much for joining me today, and I will see you next time.